How long should you keep your tax records? The IRS website has a page that claims to answer this question. But how accurate is this information? Are there things the IRS forgets to mention? Is there advice the IRS gives that could lead to disaster? Watch this video to the end to find out the things that perhaps the IRS doesn't want you to know about. So what are the general rules? For most people, they can get rid of their tax records after 3 years. Why? In most cases, the IRS is really only allowed to audit the last 3 years. For instance, right now it's 2018. In 2018, 99% of the examinations the IRS commences are for tax years 2015 to 17. But many of you might have heard about the rule that says you need to retain your records for at least 7 years. So where did that rule come from? The answer is that the IRS has a few exceptions to its 3-year look-back period. If you understate your income by more than 25%, the IRS can go back an additional 3 years for a total of 6 years. But that's sort of an interesting paradox. How does the IRS know you understated your income by 25%? Wouldn't an auditor have to conduct an examination to know that you did that? And this is why we see so few audits that get opened for 6 years. The IRS needs to have a credible information to say you understated your income by 25% or more through some verifiable source before the audit begins. What's the most common way that happens? Taxpayers and their representatives get a little sloppy. They don't organize their files correctly when under audit and just jump too much data on an auditor's desk, which includes information for years outside the standard 3-year period the auditor was originally examining. The fraud exception. Another exception is if you file a fraudulent return, the IRS can examine and assess indefinitely. So the IRS advises you to keep your tax records indefinitely if you file a fraudulent return, which I suppose makes sense from the IRS's perspective. But let me tell you a story that demonstrates how this advice helps the government, not taxpayers. Before he hired us to negotiate a settlement, our client Mike got involved with one of those tax protesters groups. He stopped filing his taxes, but he had every one of his records for the last 20 years. So the grand jury subpoenaed his records by sending a notice to the custodian of records of Mike's corporation, which happened to be Mike. So a Fifth Amendment claim against self-incrimination would likely not work. Because all of his records were perfectly kept, the IRS was able to assess him for years they would have had a difficult time doing otherwise. If Mike got rid of the records or they were just gone, the IRS would probably be limited to assessing the years only more recently. If the IRS only assessed the more recent years, his balance would have been lower, meaning that perhaps he would not have been charged criminally, or at least, at a minimum, his sentence would have been greatly reduced because the time to serve is calculated on the claimed loss to the government. Now, I'm not advising anyone to do anything fraudulent. In fact, our long-standing philosophy is that if your current business plan requires you to cheat on your taxes, get a new business plan. Real estate and the IRS. The IRS at least correctly advises that if you have property, you should hang on to all of your records for as long as you own the property, plus that typical 3 years thereafter. Yet we encountered a case where this rule would have resulted in a $40,000 tax bill to a client had he followed the IRS's advice. Our client Rod was foreclosed on in 2008. The foreclosure sale paid off the first mortgage, but not the home equity line. So the home equity bank attempted to collect from Rod. Now, Rod's been struggling, so finally in 2016, the home equity bank wrote off his balance, sending Rod a cancellation of debt 1099, as this is considered income. However, it is possible to exempt this forgiveness of debt if we can prove the home equity line went to improvements to the house and not, say, a vacation to Tahiti. So now we need the records related to Rod's old house to prove that this income should be excluded. Luckily for Rod, he had this information and we were able to wipe out this phantom income and save him a good amount in a very efficient manner. Sure, we could have done other things if he didn't have this information, but a successful resolution was far easier because he did. Yet right here on IRS.gov, it says for Rod's situation that he should have been able to get rid of those tax records a long time ago. Some big misses here. FBAR record keeping. The Report of Foreign Bank Accounts, or FBAR, is a U.S. Treasury form that is administered by the IRS. For decades, the form was ignored by the IRS. However, this changed in 2009 when the IRS realized it could use the threat of ruinous FBAR penalties up to 50% of account value to cajole people into the first offshore voluntary disclosure initiative. So there is this failure to file penalty for FBARs, yet there is also a penalty for failing to keep records. You must keep records on all foreign bank accounts for 5 years. The fact that this information is missing on IRS.gov is understandable. The IRS has a lot on its plate, but it's also unforgivable because the IRS is rather obstinate about finding that someone had reasonable cause and is entitled to an FBAR penalty waiver. It is unforgivable as the IRS is fine taking 50% of someone's assets for this FBAR record-keeping oversight. But it's the same exact oversight IRS.gov makes. It fails to mention the 5-year record retention requirement on the record retention webpage. So why are we holding taxpayers to a higher standard of care than the IRS? What about if you were audited? The IRS does not mention this, as this advice would probably help you, not them. If you're ever audited, you might want to hang on to those audit records forever. Why? Because you may be audited later and you may be raising a claim that the IRS was previously okay with, or due to their bad advice, helped contributed to the new problem. We had a case of a client who was audited twice in the 2000s. Bob, who had a business in Belgium, and told the auditors about the business and checking accounts in Europe both times. Both times he gave them all source documents. Yet during both examinations, the auditors failed to mention to Bob of his FBAR obligations and his Form 5471 requirements, even though it was incredibly obvious to anyone with knowledge of international tax law that he had these requirements. The audits closed with no changes, so Bob assumed he was doing everything right. But no. The IRS, now all hepped up on its new FBAR and international focus, audited him once again and attempted to assess him massive FBAR and Form 5471 penalties. We asked for the files of the audits from the IRS, but surprised they didn't have them. And so we asked Bob, hey, you happen to hang on to anything from the audits? Sure enough, he did. And thanks to the records he kept, the IRS agreed to vastly lower penalties. The fact is that Bob saved himself 6 figures in penalties because he hung on to records IRS.gov made no mention of. The foreign assets and income trap. Speaking of Form 5471, which is a type of foreign informational return for U.S. shareholders of foreign corporations, well, there is a litany of other foreign informational returns, and they all have the same problem. These other forms include Form 926, Form 3520, Form 3520A, Form 5472, Form 8621, 8858, 8865, 8938. The problem is this. If the IRS deems you to have made a substantially incomplete informational return, the IRS can open your entire return, no matter how old it is, to a complete and full examination. So in fact, the IRS's entire webpage dedicated to record retention becomes wholly obsolete if foreign informational returns are involved. Again, if the IRS deems any foreign return substantially incomplete, then there is no time limitation on additional assessments. So if you file or are supposed to file any of these foreign informational returns, you might want to ignore the IRS. This is explicit advice, and rather hang on to these tax records forever. So these are just our observations from the IRS's own interpretations. I know we have plenty of tax pros and some pretty savvy taxpayers watching our channel. So ask those of you with some experience dealing with the IRS, take a look at this IRS records webpage. Can you think of any other advice the IRS is giving that is completely wrong and will lead to disaster? Please leave those in the comments below. Tax Reform 2.0 is heating up. Be sure to subscribe to our channel to get the latest tax reform updates. Like and share this video if you think it could help anyone. This is Anthony Parent of Parent & Parent LLP, IRSMedic, and I thank you for watching.